And next up is Bennett McDowell from Traders Coach. As a financial advisor and securities broker, Bennett A. McDowell, founder of TradersCoach.com, developed a niche in active trading and in investing for a community of high net worth clients using his own proprietary trading systems. This successful approach later became known as applied reality trading, or the ART system. McDowell brought ART software to the public in the year 2003, and today it is used in over 55 countries around the world by sophisticated hedge fund managers and individual investors alike. Considered an expert in technical analysis, McDowell speaks at trade shows including the Traders Expo and writes articles for leading publications such as Technical Analysis of Stocks and Commodities magazine. He is honored to be included as a member of the eSignal Trading with the Masters team, and also to present the TradeStation Morning Market Briefing every Wednesday. In addition, TradersCoach.com has received numerous S&C Magazine Reader's Choice Awards. McDowell has written 3 best-selling books published by John Wiley & Sons, The Art of Trading, A Trader's Money Management System, and Survival for Traders. His new book, Elliott Wave Techniques Simplified, will be released by McGraw-Hill in 2014. So without further ado, I bring you all Bennett McDowell. Bennett, thank you for being here, and let me unmute you so you can speak there. All right, go ahead. Let's make sure your audio is working.
Hey, James, thank you so much. I want to thank you for having me, and I also want to thank Investors Inspiration for putting on this event today. Really a great educational material. All right, well, let's do our standard audio check here. How are we sounding out there? Testing 1, 2, 3. Of course, a lot of the volume can be controlled right on your PC, but just let me know. Okay, Tamara, great, good. Okay, we're good to go then. All right, you should see my screen too that says trade size really does matter, which is going to be our topic today. And of course, the purpose of this is to boost your profits with effective risk control and money management. Now, let me ask a question. What is trade size? What does that mean to people out there? Because some people get confused about trade size. And what's another word for trade size? Anybody out there? Don't be shy. Okay, stop losses, risk. Well, I'm kind of looking for something a little different here. Risk management. Well, those are all encompassed by what trade size can do for you. Proper size, position size, there we go. Okay. Contract numbers, now we're getting into it. Shares, good. All right, so I just want to clear that up because a lot of times I'll be talking about trade size and people aren't really sure what I mean. And trade size, really another word for it is position size. If you like to go to Las Vegas, it's your bet size, okay? It's how many shares of a stock you're going to buy or sell short. And if you're dealing in options, it's contracts and, of course, futures as well, okay? In the Forex market, it's pips. So the size that you bet, so to speak, or the size that you go long and short on, all right, is what we're going to talk about today and how to determine the correct number of shares and correct contracts and so forth. And it encompasses a lot of different types of items we need to discuss in order to arrive at that. Now, James did a good job introducing me, but if you want some more information, if you like what you hear today and you want to have a little more education on trade size, we got a great book called The Trader's Money Management System that goes into this. I just am putting a link up there right now that's going to take you to an area where you can bookmark the page and take a look at these books later. And what it is, it's a page that we have developed for our online store for Amazon. So basically, you would be ordering your books from Amazon if you want. But, you know, if you want to order them from Barnes & Noble or another one, you can certainly do that. Now, I got another book down there called The Elliott Wave Techniques Simplified. That book is not released yet. It's coming out this fall to winter. And if you're into the Elliott Wave, then you can pre-order that as well. But you're probably going to want to stick with the Trader's Money Management today because that's pretty much what we're going to discuss here. And I'd also like to just welcome everybody to our website at traderscoach.com. We have a lot of cool stuff there, a lot of free stuff. So feel free to come over, take a look at what we got. We also got free trials on stuff. So there's a lot of good information there without costing you a dime. So come on over and visit. We love to have our visitors there. Quick disclaimer I have to do before I do any webinar, of course. In trading, there's risk. So I have to tell you about that. But, you know, without that risk, guess what? There's no opportunity. And that's not only for trading, but that's for life as well. So we have to sometimes take the risks in order to gain the profits. But what we're going to teach you how to do is really keep a handle on that risk. Control it as much as possible so you have the odds in your favor, because that's really what trading is all about. All right, and again, here is the actual link that I put up there for the Trader's Money Management System. All right, let's move on here. Okay, quick question out to the audience there again. Do you need risk control? Do you need it? Do you need money management? And what's the difference? What's the difference between risk control and money management? A lot of times risk control, when people talk about money management, they're talking about risk control. I tend to think as risk control as trade risk. In other words, how do you control your risk on each and every trade? And when I think of money management, I think more of record keeping, trading with risk capital, and kind of portfolio management stuff. Okay? Yes, yes, we're getting yes, 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 you bet. Okay, good. Yeah, you need it. All right, folks, you're going to have a very hard time being successful in this business without risk control. I know entries and exits are important and they're exciting, but if you don't have risk control, all right, and keep those losing trades as small as possible, you're going to have problems. Because the reason is just very simply, is we just don't win all the time in trading. All right, this is a fact. Some losing trades are a normal part of trading. And so we know they're coming. We don't know always when they're coming, but we do know we're going to have them. And so you want to prepare on each and every trade to make those losing trades, if they occur, as small as possible. And obviously, you want to be optimistic on every trade you take, okay? You have an entry system, you have a set of rules you're following, so you're going to have the odds in favor if you're using a system you've tested and you're good at using. It's a tool, all right? So you're going to have the odds in your favor, but you still are not going to know which trades you're going to lose on, so you have to have risk control on every trade. And if you think about it, you know, in Las Vegas, the casinos, all right, live by this, all right? They absolutely live by this. They know they're not going to win every hand of blackjack or poker, but you better believe they have the odds on their side, okay? That's what you need to do as a trader. You have to have the odds on your side. So your goal, all right, in risk control is keeping your losing trades small and let your winning trades run. You need to develop a systematic approach to money management. What does systematic approach mean? What do you think that means, systematic? Systematic. What are we trying to get at here? Based on some criteria. Good, Lee. Have a rule and stay with it. Good, James. Consistent. Good. All right. Everybody's got it. We want you to develop an approach with risk control, just like you have with your entries and exits, where you have a systematic, consistent way of doing this on each and every trade. All right, how? So how do we do it? All right. Well, the first thing we're going to do is talk about calculating your percent to risk. Now, your percent to risk is not the same as your trade size. Your percent to risk is basically, there's two ways to think of percent to risk. It's how many dollars you have in the trade, okay? That's basically your buying power, how much it costs at the entry price. That's 1% of risk. The other percent of risk is called what I call a trade risk percentage, and this is the amount of risk that you have when you go into a trade, but you know your stop-out level. So if your stop-out level is at a certain price level, you know if you get stopped out instead of making a profit, then you're going to lose a certain dollar amount, which will represent a percentage of your overall account size. So we want to calculate the percent to risk, and we're going to probably focus mostly here on trade risk. Okay, so trade risk. The other risk is called market risk. How do you control market risk? By putting dollars in your trading account that you can afford to risk or lose. All right? What's a market risk event? Anybody out there? What do you think a market risk event is? War. Good. That is a market risk event. Putin. Okay, that's a good one, James. Earnings. All right. Anything that can what? Cause the market to really move quick, and at times, if it's a real market risk, it's probably going to do what? move past your carefully chosen stop level, isn't it? You know, like a gap, for example, okay? And when that happens, all right, if you have a stop loss in at a market order, which you should have, by the way, all right, you're going to get taken out of the market no matter what the price is. So if it gaps past your stop, then guess what? Bingo. You're going to take a larger loss than you thought or you calculated for. What can you do about it? About the only thing you can do about it is fund your account with risk capital. This is why I don't care what your net worth is. Any of the great traders out there will not trade with their entire net worth because of market risk. It's just something we totally can't guard against except by the amount of dollars in your trading account. Okay, and how much should that be? That's a personal decision depending on your liquid net worth and so forth. All right, but and it will vary depending on how your experience level is as well. And I address this by the way, in my money management trading book. So if that kind of interests you, go in that direction. All right, your trade risk, okay, on the other hand, is going to be what we're going to focus on today and how we can control that. But I can certainly tell you if you have a market risk event and you're using really good trade risk calculations, then the market risk event in most cases, it doesn't occur often, very, very small percentage of the time, but when it does occur, if you're not prepared, it can wipe you out. But if you have good trade risk and you're using it on each and every trade, it usually amounts to a setback and not a disaster. That's the difference. All right, so we're going to also calculate your trade size for each trade. So this is what we're going to do to focus on risk control today. All right, now, I have two pieces of software that basically we use in risk control here. One on the left-hand side is called the Trader's Assistant. The one on the right-hand side is called the Trade Size Calculator. The Trader's Assistant is kind of what I would call a money management software, in that it's going to keep track of all your trades for you. All right, it's really a slick piece of software. It does a great job. It goes far and far above and beyond your broker's statement or your online broker's calculations. This thing will spit out the right percentage based on the risk of ruin calculations in Optimum F that you should put in to the trade size calculator. So on the trade size calculator on the right, you can see the percent risk in red there. And notice we've got 2, all right, but that percent risk is a variable that can change based on your performance. And this is what the Trader's Assistant is going to tell you what to put in there. As a rule of thumb, if you're winning at least over 50% of the time and your win-to-loss payoff ratio is over 1-to-1, you'd probably be okay with 2%. If you're winning 60% of the time and you got a 2-to-1 payoff ratio, you can go a little higher. All right? If you want the exact number, use the Trader's Assistant and it will calculate that number based on your closed trades. Okay? All right, let's talk now generally about money management. All right, it allows you to be wrong, and we already discussed and know that we're going to be wrong sometimes. All right, it helps control risk, takes into account that every trade can be a potential loss, separates the pros from the novices. All right, can you think back when you first started trading? You probably didn't know much about risk control. All right, you may have had some pretty lucky trades, but it was darn exciting, wasn't it? You got into a trade, you felt you were participating, market was moving, but you really didn't have a handle on risk control, and sometimes you would get lucky, but the more you did this, you started doing counter losses and it didn't become quite as much fun, and so then the reality of what you're up against sets in. Now, if you implement risk control back into it again, we're going to show you how to put that excitement back into your trading. Money management is a state of mind. Okay, I really want people to think about that. Money management is a state of mind. What does that mean? This is important. What does it mean that it's a state of mind? Anybody out there? Money management is a state of mind. Going once, going without emotion, okay. Trading should be unemotional, good, less stress when your risk is a plan, okay? Money management is a state of mind because I think you have to have the mindset, the belief. You ever hear the words beliefs? You have to have the belief that every trade can be a potential loss no matter how good it looks at the start. No matter how good that pattern is, no matter how good that's set up, no matter how good the probabilities are on the trade, you have to have the mindset that, hey, it may not work out. All right? So if you have that mindset, you're going to be forced to use risk control. If you don't have that mindset, if you don't have any idea about, hey, this trade could be a loss, or this trade could be a losing trade even though it looks good now, or may start out as a winning trade, but it could end up as a lose. If you don't have any of that reality, then you're not going to use money management. You're just going to wing it and go with the trade, have your stop set maybe, okay, maybe not, all right? And then just get out, as the plan would say, when you're profitable. But then when it starts moving against you, all right, that's when you have the problem. So the purpose of me being here today is for you to change your belief system so you don't have to experience the large loss. Instead, we want you to take the material here and start out on the right foot, so to speak. Okay, so really important stuff. All right, elements of money management. How much to risk on each trade, calculating the trade risk, trader's assistant, we talked about that, trade size, calculator, which we abbreviate as TSC. All right, risk management, we're going to discuss that. We haven't talked about that. That's the risk of ruining and effective stop loss placement. All right, now I got one more question. I'm big on questions, as you can tell. All right, now what causes traders to not use money management or risk control? I want you to all think of an experience, probably earlier in your career, where you suffered an excessive loss because you did not use risk control. Then ask yourself why you didn't use it, and what did that experience feel like? And I want a couple of you just to share, everybody just share their feelings in there, okay? I'm interested to know why you didn't use it and what did the experience feel like. I felt so smug, okay? My broker said it would come back. Yeah, right. Okay, fear of loss, okay? You know, that's an interesting thing too, the fear of loss issue. Good point there. You think you can get your money back, prior experience of being shaked out. Right. All right, great. These are great answers. All right, usually what happens, all right, when we trade, all right, this is another mindset you got to change, is when you start out trading, what are you always doing? You're always trading your last trade, aren't you? All right. Doggone it, last time I saw the market like this, it went up and it took all my money out the next day. So I'm getting out here. And then, of course, what happens? The market keeps going, and you got out of the trend way too soon, didn't you? All right, so that happens sometimes. All right, likewise, you had a stop in place. The stop was hit by one tick, and then what happened? The market took off again, didn't it? All right, then now the next time you trade, your stop gets hit. You say, you know what? The last time this happened, it just went down by a stop by one tick, and if I'd stayed in it and not used the stop, I would have made a fortune. Okay, so this time you don't get out, and then what happens? It keeps going down. All right, and then you got a huge loss to a point where it's so large you can't take it anymore. And now you've turned from an active trader into a hoping investor on probably a momentum stock that you should never be invested in for the long term anyway. How many have experienced that? Believe me, I've done all this, okay? I've experienced all this in my career, all right? Thank goodness early on in my career, but we've all done it, I'm sure, all right? So you kind of get bounced around like a ping pong ball, and then your emotions get bounced around, then all of a sudden you start that spiraling down, and it's really hard to recover from that, okay? All right? So the idea here is that you have to adhere to your stops. Some people will say, well, market makers will run them no matter where you have them. Okay, they will not run your stops if you're trading or have your stops set properly at key levels of support that were put in by good, solid volume or liquidity. So much liquidity that no matter what the market makers try to do, they can't force the market because there's so many traders, okay, they're overwhelmed by it, all right? The power of the volume or the liquidity where you set your stop is extremely important because that's going to keep the market makers from driving you nuts, okay? Good point, though, all right? So anyway, I just want to cover that because I think that's an important situation, all right? All right, healthy money management, therefore. The psychology begins when you realize that each trade's outcome is unknown and you protect yourself. All right, let's move on because I want to get, we're kind of got to get going here. Profitable money management occurs when you truly believe that you need it. I think everybody's got a handle on that. We talked trade risk versus market risk. All right, trade risk, okay, we control that by controlling our trade size, and I'm going to show you how to do that. Account size controls your market risk, and I kind of discussed that in pretty good detail before. If you have any questions, of course, feel free to ask. All right, I want to talk a little bit about the risk of ruin tables, okay, and try to talk about what that means. But in order to do that, we have to go over a few terms first. So let's talk about the win ratio. I'm sure you've heard of the win ratio and the payoff ratio. And if you haven't, by the time you're done here, you're going to know what it is. All right, your win ratio. How many trades do you win versus how many trades do you lose? All right, payoff ratio. How many dollars do you make for every dollar you lose? And here's the formulas. For the win ratio, just take the number of wins divided by the total number of trades, okay? So let's just say you did 100 trades and you had 60 trades winning, 40 trades losing, so you'd have a 60% win ratio. All right, pretty simple, right? That means that for every 100 trades, you're winning 60 and losing 40. Pretty simple. Payoff formula is the average winning trade divided by the average losing trade in dollars, okay, or whatever currency you're using, all right? So if you had an average winning trade of 300 divided by 100, it's usually represented as a ratio, and in this example, it would be 3 to 1, all right, which is very, very good. Now, this is kind of an interesting chart, okay? This shows you the relationship between the win ratio and the payoff ratio and vice versa, okay? So basically, if you have a win ratio of 55% and a payoff ratio of 2 to 1, all right, your chances of going bust when using, this is probabilities of 10% of capital at risk. So your probabilities of going bust are 0.2%. That's small, okay? That's small. What is it if I have a win ratio of 50% and a payoff ratio of 1 to 1? What is it then? Look at this, 99% probability of going bust. That's high, okay? Look at all these 100% on a 1 to 1. All right, so there is a relationship between the win ratio here and the payoff ratio here, isn't there? They're kind of married. And when you adjust one factor that can control either one, because they're married, you're going to have an outcome that affects a little bit of both. So for example, if you change the way in which you do stops, that may certainly affect, all right, your payoff ratio, okay, and your win ratio for all practical purposes. They're always related. They're married and related. So very important to realize that. What I kind of do on my own trading is I kind of look at the win ratio and I kind of try to make my win ratio as high as I can through my entries and exits, and then my payoff ratio is usually controlled through my trade size. So that's just kind of the way I do it, but we all do it differently, but they are married, so it's an important concept. So the idea here is if you can get your payoff ratio 2 to 1 and your win ratio above 50%, you're doing pretty good, aren't you? Increase the payoff ratio or increase the percentage of wins, and you're good. By the way, how many people think a win ratio of 60% is good? Forget the payoff ratio for a moment. What do you think about a 60% win ratio? Is that good? Yes. Yeah, good. It's good for consistency, all right? Some people say no, all right, great, yes. Yeah, it's good, all right? Even the most experienced traders, all right, they're winning about 60, maybe to 70%, but usually what happens, and I know with my trading, is if I'm on a good winning streak, I will get higher, but over time I'll hit an area where I don't do as good. Now I have a couple little ideas to help me get through those, like using options and things like that to hedge positions, but I'm just talking about raw win-to-loss ratio in my trading approach. So 60% is really good, okay? Really, really good. And it's a consistent, that's what you want to be consistently. Now there'll be markets, especially if you're a good trend trader, that you'll be winning 80% of the time. But markets don't always trend, so that's going to bring you back down to reality. All right. So again, you want to use risk control on this. I think it's really important, and this is a great diagram that really shows you the importance of that. Okay. Here's one at 45%. So now you're at 100. 100%. That's 100% that you could lose your capital. That's pretty high. All right. So I think what you want to take away from this is that the risk of ruin is possible. So you need to implement this awareness into a money management or risk control strategy. And I'll show you how we like to do that, okay? All right, a couple more things here. All right, risk control is based and takes into account a number of factors. We've looked at the risk of ruin tables, where your performance, okay, can come into effect here, and a whole host of things of where your entry, where your exit, and how you set your stops, okay? But for now, what we're going to do is I'm going to assume that you have a trading approach that you're comfortable with, you've tested, and you're winning with. So by knowing that information, you actually should already know your payoff ratio and your win-to ratio. So I'm going to show you some techniques here where you can actually fine-tune your risk control for even greater profits. All right, one quick observation I want to share with everybody, because I do a lot of consulting, and I noticed that novice traders usually trade the same trade size on every trade. So one of my first questions during a consultation is, talk to me about trade size. How many shares of a stock or contracts of a futures market you buy or sell. And it's interesting, if they're stock traders, they normally will tell me, 1,000 shares on every trade. All right. So as soon as I hear that, I'm a little subject of their risk control procedures, because that means their stop would have to be moved to price levels to accommodate a decent or low trade risk. All right. The problem with that is that you need to have your stop loss levels set at key levels in the marketplace, because those have more meaning than just pulling your stop up to any price level. Okay. All right. Here's where the trade size calculator comes in. All right. Now, the trader's assistant can be used to put the percent risk in. Again, 2% can also be used as a rule of thumb. All right. If you bought the trade size calculator today and did not buy the trader's assistant, just use 2%. You'll be all set. Okay. That'll handle most cases out there. All right. So here's an example of an actual entry using the trade size calculator. So let's just walk through this so you understand it. Okay. So the first thing on this particular example, all right, is we have a trade entry price level up here at 26.99, and this is for a stock. It's for Intel a while back. Okay. Stop loss exit down here at 25.45. So basically, we're using this resistance level here and this support level here on this price bar as our stop. Okay. And so here are the actual levels, with the raw risk is the difference between the entry and exit price. So we're assuming in this example an account size of 50,000, a 2% risk for the amount to go into the percent risk field in the calculator. 50,000 goes into the account size. The entry price, $26.99 and $25.45. Okay. We set the calculator up to give us as most of an accurate figure as it can when it produces its results. So we want to put in what the round robin commission will be in here. All right. This point value is simply to calibrate the calculator. So in some futures markets, okay, like the S&P E-mini, the point value is $50. So you'd have to put that in. The margin on stocks, if it's an all-cash account, would be 100%. If it's a 50% margin account, it'll be 150. If you're in the futures market, then you would have to set that based on the margin that the broker requires for that particular futures contract. All right, so once you get all these variables in, you hit calculate, which is this button right here, and these are the two answers that come out over here. Okay, trade size and dollar risk. Now, what's 2% of 50,000? What's 2% of 50,000? And that is risk per trade, Lee, correct. 1,000, okay, 1,000. B, just add an extra zero in there and you're right on the money there. Okay, 1,000, okay? So we want to make sure that when we get stopped out, or if we get stopped out, that our loss does not exceed $1,000 because we don't want the risk to be more than 2% of the account size. Everybody follow that? All right, so 2% of the account size. Got it? Now, so there you have that example. All right, so now let's move on now, and I want to show you some other things here. Okay, here's the question associated with that. So we kind of already walked through this one, but now let's walk through it, okay, without the trade size calculator. All right, let's see what formulas are inside the trade size calculator. This is what we actually program the calculator to do. All right, so you take the account size, multiply it by your risk, and that's step one. So we know we don't want to be losing any more than $1,000 on any given trade. Okay. The next step of the calculation is take the risk amount minus the commission, so we get a realistic figure here, net figure, and divide that between simply the difference between the entry and the stop. All right, so in our example it was 154, and that yields you the 242 shares. All right, and there's your answer, and Martin's got it as well. Okay, here's a close-up picture. Okay, so let's move on here. Let's keep going here. There's your answer. All right, we're going to move on to another one here, okay? All right, so this one, all right, is a little different, this question. Pretty much the same account size. We're trading with a stock margin account, so you can margin 50%. This increases your buying power to 75,000. Your trade using the 2% risk rule, your entry is 91.49, and your initial stop loss is 90.23. Your commission round robin on this example is 51.22. So now here's the question. How much is the total cost of your initial trade with a 2% trade size calculated? So we got 1,000, 1,500, 68, 891, 1891, 70. What are we asking for here? A lot of words. So what are we really asking? What's the question really asking? All right. Okay. It's really asking what buying power is going to be required, okay, for us to initiate a trade with 600 or whatever trades that this is calculated at. So let's take a look and see. All right. So the trade size calculator, if we start putting in the variables, okay, account, risk, entry price, exit price, all right, commission, margin, down here, and the point value is already set for stocks because that's 1. All right, so we hit the calculator. It gives us 753 shares and it's exactly $1,000. So in this example, that's, of course, 2% of 50,000. So then you just simply take this figure, the trade size that it calculated, 753 shares, multiply that by the entry price, 91.49, and this is the buying power that it's going to take in order to execute this trade. So what's happening here? We have a $50,000 account. So we're actually using 18,000, pardon my penmanship, 891.97 in margin to enter this trade, aren't we? Okay, so we're actually using margin, okay, for this. So the purpose of me showing you this is that a lot of people get confused. They think when they hear percent risk of 2% on 50,000 being $1,000, they think we're only buying $1,000 of the stock, but that's not true. Okay, our loss is kept at $1,000. Okay, now the point value. I'm getting some questions on that, so let me address that real quick. The point value on the calculator is a value that we put on there that calibrates the calculator itself to the kind of market you're trading. So a point in the stock market or ETFs is equal to 1. If, for example, we had the S&P E-mini, the point value is 50, and we'd have to change the calculator to 50 and also hit the futures button over here. Okay. So again, we have really good instructions on how to use all this, and once you use it once or twice, it's easy. It's a piece of cake. We use it for trading the 2-minute E-mini as well. All right, so here's just the answer repeated in the question, 68, 891, 97. All right, now we're going to go to the futures market. All right, and here's another question, question number 3. All right, your trading account again is $50,000. You are trading the S&P E-mini, which is the ES contract. Margin requirement by the broker in this example is $3,500. You trade using, again, the 2% risk rule. Your entry is $10.88.25 per contract. Your initial stop loss is $10.85. Your commission is $10. All right, and here are your possible answers: 10 contracts, 3 contracts, 6 contracts, or 2 contracts. So again, we go back to the formulas that are built into the trade size calculator. All right, we go to work on those. That's 50,000, same 1,000 as we figured out in the one we did for the stock market. The only difference here, all right, in the calculation for the futures market is we added the point value has to be considered, okay, to calculate this into, when you have a 1, you don't need to worry about the point value. But when you have anything other than a 1, like in the futures market, then you have to put it in there, and the calculator needs to know that. And so the answer then becomes 6 contracts, all right? All right, so the risk amount is the account size minus commissions, the difference between the entry and the stop, in this example, 162.50, and then we need to know the point value, so we make sure we have it calibrated properly, and that gives you the 6 contracts. So that's the answer, okay? And there's it in the calculator. It's just so much easier putting it into the calculator because it just does it all for you. All right, so let's move on here. All right, and here's the example that we just did using the S&P E-mini contract. Okay, I got a question for you. Okay, let's see if the question comes up next. This is the answer to the other one, so let's move on from this one. All right, here's our question. If the distance between your entry and exit is closer than 575 from the previous example, then would your trade size be larger, smaller, or the same? So we calculated the trade size based on a $5.75 raw risk. So let me go back. Let's go back and take a look at that. So we're saying, okay, if the distance between your entry and exit is closer together, what's that going to cause in terms of the actual trade size? No, I don't see the example. Okay, so let's just keep going. Okay, larger. All right. Anybody else? Lee's saying larger, more contracts. Okay. All right, oh, here's the example. Okay, so here it is. Okay, so if you have here this, and the entry and exit was instead closer together, I knew I had this slide in here someplace. So if the entry and exit just happen to be here and here, to cut this down to, let's say, $3 or something, all right, then the question is, would the trade size be larger or smaller? So everybody's answering, all right, and I think probably this is a really good example because if we look at this, it's larger. And the reason for that is because when we solve for your actual trade size, the percent risk remains the same. So this is why you can use this method with any trading system, because you don't have to be worried about the size of your risk between your entries and exits. All right, you just have to have one of each, okay, in order to calculate. So you want to do these calculations, all right, as this trade is getting set up to be taken. All right, let's take a look at this example real quick in the real-life markets here. If we go down to this area A, which I'm circling with the pen here, This was a first entry here based off this little entry level that we use called pyramid trading point. All right. So trade number one, all right, it was an entry at 20.47. All right. We had a stop loss at 19.30. So if we go up to the trade size calculator up here, all right, then we'll see these variables put in here. Okay. Bink, bink. All right. Then the market moves up here. All right. And we want to add into the trend again. And since we have a new stop loss level, a trailing stop loss level, what's happened to the risk, the trade risk on the first trade? Anybody? What has happened to the trade risk? On the first trade at A? Evaporated. Good. Lower. It's gone. Why is it gone? Now trade risk, not market risk. Why is the trade risk gone? Because we have a new stop loss level that if we're stopped out here, we made a profit on the first trade, so the trade risk is gone from that. So now we can go ahead and pyramid into the trend again and do it with a trade size calculator again like down here. And in this case, all right, we do it for 2% again, all right, and we just added another 478 shares, okay, into the position. What's our risk? 2%. So here's a way to add into a trade without increasing your trade risk. Is that clear to everybody? Have you ever heard of doubling down? What does doubling down do? That lowers your cost basis, but it increases your risk. Doubling down means, for those that don't know, is that you enter a trade. Let's say you entered it at $20.47 right here, but instead of going up, prices kind of came down here, meandered a little bit. You didn't get stopped out yet, and you decided to add more on here, okay, at this point. All right, so let's say you go in at $19.75, all right, and you add in some more shares. Well, now your risk is more than 2% because your first position is not profitable. You did lower the cost basis, however, but you also increased your position size. So in doing so, you got to be careful. That's called doubling down. You don't want to do that in short-term trading, okay? All right? So this is an effective way to manage a trade, all right, even by adding into the position, because if you see at the top, notice here, okay, that with the initial trade, all right, that was 846 shares, gave us 9,766. The add-on share, all right, was 478 shares for another 2,000 for a total of 11,000 or a 38% return. Okay. Now, if we had just stuck with one entry, our total return would have been 9,576. Still not bad, but this is a way to juice out more profit without increasing your risk. Okay, your trade risk. So in this example here, if the second trade did not go up, but instead faltered and failed and went below this trailing stop and you were stopped out here, you would have lost, okay, $999.46, but you would have profited quite a bit on this first trade. So you would have still been in good shape. You do that consistently on big trends, though, and this second method should prove out to be a very good way in which to juice out more profits on a more consistent basis while not increasing your trade risk. Okay. All right, so we covered quite a few things here, all right? But what I want you to take from this presentation today, all right, is there's some immediate action steps you can do. You can calculate your trade size on every trade, all right? Everybody can do that, all right? You can use initial and trailing stops on every trade. Everybody can do that. So you should be doing that. Now, I will say On the trailing stops, you may want to get my book because I talk a lot about how to do the trailing stops on that if you're not happy with how you're doing it. But you do want to have trailing stops and initial stops used for every trade, and you want to be consistent in how you do this. And also, too, you need to know when you first take a trade what price level before you go in where you need to get out. In other words, you need to know what stop loss level, what your stop loss level is before you get out. Okay, that's really
Hey, Bennett.
important. Yes.
Not to throw you off or anything like that, but we are running a little over on time right now.
Okay. Oh, you're right. I thought it was an hour. Okay.
Perfect.
Gotcha. Okay, I'm really done right now, so let me just go ahead. All right. So let me put in what we have for you guys and gals out there today. Basically, we have a trade size calculator. We just updated it. We call it the Plus because it adds 4x, okay? It has the 4x to it. And so if you're a Forex trader now, you can use it, but it works in the same fashion. And the idea is normally we sell this for $2.98, okay? But we're going to, for the first 40 orders, we're going to do it for $49.98. Why are we doing it that cheap? Because we want everybody to be using risk control. This is something everybody from the novice to the experienced trader is doing or needs to be doing. And so use risk control. It's so important. It's going to make a huge difference in your trading. And this calculator is just a great way to do it. All right, so you should have the link up there. I put the link up there, so just go to it, bookmark the page. But the first 40 hours is going to be doing this. When the page goes away, that means the offer's done. Okay, so if you use the link later on and the page is not there, it's done. All right, but we wanted to do this. We wanted to do this for everybody here at Investor Inspiration, just so they had a chance to incorporate risk control. We think it'll make a huge difference in your trading. Complete instructions are included. All right, so that is it. Listen, thank you so much, okay? Really great participation. I want to really thank everybody for coming today. And just remember, always use risk control. That's the key. All right, so James, I'm going to turn it back over to you. I want to thank you for having me again. And what a great opportunity for all of you to attend some really good education. I was listening to quite a few of the speakers here, and they're really